Start now, Pramod.
Hello and welcome to Marcellus webinar on global compounders. Today we want to focus on a specific aspect. They say that there is no such thing as free lunch in life, but we are fortunate to have a potential free lunch here. We'll talk about that in more detail through this webinar. But broadly, as we've been highlighting over the last few months, asset allocation and diversification are crucial aspects of personal finance. Just like you diversify across different asset classes like equities and bonds and real estate and gold, there is scope for benefits of diversification to be achieved through geographical diversification. As much as we are all gung-ho about the prospects of India over the coming few decades, it doesn't make sense to put all our eggs in India's basket. To that extent, diversification is required. And whilst we all know the benefits of diversification through risk reduction, I reckon there is more to it. We can show examples where there is potential for return enhancement through diversification. So the Global Compounders portfolio launched 2.5 years ago was launched specifically to provide this benefit to Indian investors. We've run this portfolio for the last 2.5 years. Many of you have invested with us and seen the performance, albeit over a short period of time. 2.5 years is not long enough to judge. But to talk about these in more detail, I have with me the members of the Global Compounders team. Arindam Mandal, who's the portfolio manager, Jaybir Sethi, who handles the research function, who heads the research function for our Global Compounders, and Kumar Mayank, who helps with the research piece as well. With that, I hand it over to Jaybir to take us through this webinar. We'll be opening it up for Q&A as Jaybir and Arindam finish their piece. Meanwhile, if you have any questions, feel free to start dropping it into the Q&A box at the bottom of your screen. Over to you, Jaybir.
Thanks, Pramod. So some of what Pramod talked about around diversification, around enhancement of returns, of risk mitigation through investing in different markets, that is something I had explored for myself in 2022. There was a bunch of questions which I asked myself, then explored the answers. In the discussion today, I'll ask Arindam some of those questions, and we'll see if the answers may have changed over time. I don't think they would have, but that's the thing that I'm personally curious about. What I'm expecting is the same rationale for diversification that I got to 2.5 years back is probably the same rationale for diversification that holds true today. Now, the starting question, which was true in 2022, is true today, is since we're living in a high GDP growth economy like India with very strong long-term prospects, why should one consider investing in a low GDP growth economy like the US? And Arindam, over to you.
Yeah, no, that is a great question. I mean, whenever you're going to a big school or anything, the first thing that comes to mind that if you are residing in kind of a very high growth economy, the prospect of creating shareholder value is much higher. But we did very simple exercises. We don't want to make it complicated. But if you look at again, the large equity markets across the globe, we have showed it before also. Like if you look at the best performing markets. In fact, India does pretty well, as well as US. These two are the best performing markets in the world. And in the meantime, you can put, China, which was probably the highest GDP growth in last 20 years or so. That market hasn't done really well. In fact, if you check out the last 3-4 years, the performance has not been that great. Eventually, Jaybir, what really drives return for a shareholder is practically EPS growth. And if I look at S&P 500's price return versus earning growth versus the GDP growth, the nominal GDP growth in the US, there is practically, you cannot really say that there's a much of correlation. In fact, if you think about last 20 years, US GDP nominal growth was around 4.5, right? 2.5 real, 2% inflation. That takes you to 4.5. The earnings growth has been around 6.5 last 15 years. Again, 4.85% nominal GDP growth, around 10% of earnings growth, right? And if you look at the blue bar here, that is your share price return. So it closely follows uh, the earnings growth of that market. And if you look at it for any time frame, that real GDP growth hasn't, or the nominal GDP growth hasn't changed that much, as between 4.5 to 6. In fact, the last 5 years has been spectacular in terms of nominal GDP growth. And the returns are practically almost twice. It's kind of, I would say 60-70% of that is driven by the earnings growth. When you are getting, higher earnings growth, typically with that, what you get is a bit of re-rating, and that is why you see some disconnect from the, what the market earnings have grown versus what the return you see here. But broadly, that has been consistent. The market return or the price or the EPS growth for this market has always kind of, handily exceeded the GDP growth. Partially, it can be explained by the fact that most of the US companies are actually global in nature. In fact, you can argue that they actually capture the best part of the growth that's happening across the globe. If you think about something like an Apple, almost half of their revenue actually comes from outside of the US, right? So even though they're kind of, you can mention that they are US based, but much of their growth comes from the growth that is available outside of, actually not outside but across the globe, right? So yeah, to your point that you started with, we stay in a high growth GDP, economy, which is great. Uh, Hopefully, all of us can be wealthier over time to take advantage of that. But when it comes to share market return, the driver is really earnings growth, and there is no real correlation between earnings growth of a market versus the nominal GDP growth of that market.
That's interesting. Arun. Now, the related question which comes to mind is that given the similar returns in India and the US, that do the markets behave the same? Are they highly correlated? Because if they are very correlated, then there's no real diversification benefit which would be available.
Yeah, that's right, Jabir. I mean, absolutely right. And in fact, to our surprise, when we did this exercise, we didn't expect this outcome. And to be fair, I mean, I've seen the argument around diversification across EM market versus the developed market that do exist. But when we did we always did it from, say, take MSCI World or S&P 500 and run it against broad EM, emerging markets basket. But when he did it against India, it was kind of struck me quite a bit, to be very honest. I mean, we looked into different correlations, like pairwise correlation. So we took MSCI Euro versus MSCI US, US versus China, etc. India and US, they have actually, the stock markets have the lowest correlation among the major markets. I mean, of course, you'll find here and there some smaller markets, but if you're talking about large markets where you can take some action or you can invest, these two markets has very low correlation. Just to give you an idea, you can see the band between somewhere between 40 to 70, right? That's where the correlation exists. Just to give you some reference point here, typically between two different equity markets, like if you take S&P 500 versus say MSCI Europe, those correlations are typically they run at around around 75-80%, or even Europe with Japan, it's kind of same, right? So if you look at India and US, the correlation, there's a blue line here. This is a time-based, like it's a correlation over time, rolling 5 years. So you take every 5 year, you calculate the correlation. Then again for next month, like that, it has been calculated. So that correlation stays within 50-55%, right? 0.55 on an average. Now, more interestingly, uh, if you just take out the broad events like like the events like COVID or global financial crisis where equity as an asset class was impacted as a whole, like everywhere in the world, then the correlation is actually even lower, right? So if you think about a normal world where we're not going through a severe crisis or anything like that, the correlation is around 40 to 50%, which makes, I mean, that actually make a very strong case that you have these two markets which are producing the best return, and you have very low correlation in those two markets. So it's a perfect recipe for the free lunch that we talked about initially.
Now, in the real world, how does this low correlation actually show up? That what have you lived through? Because you and I have both been in the market for a long time. What are the examples that you've lived through where you've seen this lack of correlation?
Yeah, no, absolutely, that is true. You can actually you can take just few select events that has happened over last 15-20 years, broad events, right? So if you think about India, in it has been a 2000s, 2000, the entire decade of 2000 was actually great for India in terms of not great for only India, it was broadly emerging markets. Everything was growing very fast. So the challenge started to happen for India or broadly emerging market in the early 2010s, right? When you cross that first barrier of easy or early growth. So 2020, 2011 was the first time when the EM growth stalled, right? If you look at the row number three, the India specific issues that we have listed down here. At that point of time, the market like India saw a big correction. The correction came in form of both things, right? You get a correction in terms of rupee getting depreciated. At the same time, your market get corrected quite a bit. At the same time, if you look at what happened with S&P 500, that actually did pretty well, right? So if you're holding a 50-50 portfolio, you barely fall. You're actually flat, right? So similarly, I mean, there are other examples like ILFS demonetization when it comes to India. If you think about what happened in 2022 in the US, right, the rates went up from practically zero to almost 5%. We have never seen that kind of hike. So that was a big impact for US growth equities. So US equities are down almost 10%. Nasdaq was down probably 20 plus or 25%. But India was practically flat. So again, so if you're thinking about combining these two, you are actually much better off. Now, one interesting thing of notice here, when you go through this massive global crisis, right? If that happens, both the markets go down pretty well, pretty much 15-20% in there or maybe higher than that in their local currency, but US tends to hold up much better because dollar is kind of perceived as a safe haven, right? I'm not going into the debate of what dollar de-dollarization and all these things, but as I said, uh, in a regular world, that is how typically it works out. Now, uh, why do you diversify, right? So diversification, it gives you a benefit that, suppose I give you the example of 2011, right? So suppose you saw that you are invested in both. One market did pretty well, the other one did not. So that gives you an option to reallocate your money from one market to another, right? That is a smart allocator would do. Okay. Now, what do you try to do here to show that you are investing $100 every year, okay, $100 every year in the market, where you want to make sure that your portfolio is always in a kind of sized up in a way that the allocation is 50-50 at all point of time between these two, right? And the blue line here is that where you are just allocating to India every year, you're putting $100 in Indian markets, right? uh, so if you put at both, then this is the amount of wealth that you create over 20 years of time. And that is where the practical benefits start to show up, right? So even you might be a long-term investor, but the point is that you are probably putting money on a regular basis, like every year or every 2 years. In that case, when you're doing this, kind of, making sure that you are diversified enough in the best of markets where they have low correlation, then you can take advantage of fall of one market and reallocating your capital a little bit smartly. It is not no rocket science here, very simple. But at the end of the day, you have created probably 25, 30%, 40% more wealth than you would have created otherwise.
And that is pretty close to the answer that I got to in 2022. one thing which is different between then and now is today there's a lot more chatter out there about uh, how US valuations have re-rated, how things might be uh, at a peak in terms of valuations. So wanted your perspective on that, that given where the market is today, given where the rest of the world is today, would you how would you think about valuations in the US?
No, we do share that concern that you are pointing out. In fact, if you think about this is the valuation of certain markets that we often hear about from people. So S&P 500 on the top left and on the left, the most left, 21 times forward P. Historically, it has been around 16, 16 and a half. Nasdaq historically it has been around 18, 19. So absolutely, you're right. In terms of valuation, they have definitely gone up. Uh, in fact, we have also put down some other names like India, China, Stock 600, which is practically Europe, right? If you look at their valuation is around 14, 13, 14, 15, right? That is the range. India is of course on the higher side, 18 and a half. What our point here is that if you look at the US, last couple of years has been very unique, 2.5 years, that it has been broadly driven by very select number of stocks. If you just take out the top 10, 15, 20 stocks which have kind of drove the entire market practically, you you get a market which I think is kind of reasonably valued. So as a proxy, what we did is we just took the S&P mid cap index, which is S&P 400. So it's the mid cap index in the US. So if you look at that, that is trading at around 16 times forward PE. Okay, and that is in line with last 20-25 years of historical median. If you look at that, that is the median P, and it is kind of in line with what it has been always. And we have tried to make sure that when it comes to investing, we try to make sure that we are positioned more in that cohort, that we are trying to find out quality companies in the mid cap. And believe me, I mean there are quite a few, there are a lot actually that you can find them, but you have to dig a little bit deeper. So that is where the valuation is much more palatable for a like quality company in a large cap universe. Now, um, while we are doing that, valuation is one thing. I mean, valuation is something we always speak about, and valuation definitely is important when you are entering any market. But at the same time, if you want to create long-term value, that is where the earnings growth, that is where it becomes important, because that is what eventually drives the return on a market. So if you look at the table that I have put out in the bottom, the earnings CAGR of different market. So they're corresponding to the column that lies above them. So these are all dollar CAGR, by the way. So if you look at S&P mid cap, right? So it has actually compounded historically better than S&P 500, the large cap. Now, that's our point. So if you think of a very simplistic way, I mean, I do not really believe in the PEG ratio, but if I just put it here in the context, so in the last 10 year or last 15 year, if you just take the lower numbers, 9%, that is the CAGR, EPS CAGR of S&P mid cap. The PEG is actually 1.8 for the mid cap. Now, just look at the cheaper markets that people talk about all the time. And again, not to say that when this market is trading at 10 times, 11 times, and definitely you can get a good jump to 14, 15. Because that is the kind of threshold. Historically, I've seen most of the stock markets, trading at that range. You get that. So that is more of a trading. That is not kind of, you cannot say that is investing. Investing needs IBPS growth. So from that standpoint, if you look at the dollar earnings CAGR of different markets, right? We talk about China, it has been 4% in last 15 years. If I even take out the last 3 years from the equation completely, it probably goes to somewhere around 7, 8% or something like that. That's where it is. You look at Europe, there is a reason that they're cheap, 3.5%, right? Even India, for that matter, in dollar terms, the earnings growth has been around 6%, right? So from that standpoint, of course, these are not cheap by any means, Nasdaq or S&P 500, but at the same time, there is a reason that they're pricey. And within that universe, you feel that the S&P mid cap, it is not only cheap, But at the same time, it has historically it has shown that it can actually compound at a very healthy pace of around 9-10%. So as an investor, that's where I would like to be if I am putting more money into work.
So this this entire perspective you shared uh, about valuation in the US, about how different parts of the market have behave differently. How do you actually reflect that uh, into a portfolio?
Yeah, that's a good question actually. So people have been following us. We always talk about relative valuation. The reason we do that because unless you do relative valuation, there is no idea what is the cost of equity or cost of capital, and depending on where you are, at what time, what point of a regime you are in, what is the interest rate. There's a lot of driving force. So the cost of equity or cost of capital is always a never-ending debate. So what we try to do is we always look at the index level valuation and relative to the index, where do we stand? Because if we're looking at an index level valuation, that takes care of the cost of equity, right? So that that has some implication on the cost of equity and the longevity that market is looking at. We try to do the same thing with those derived values, basically reverse engineer those values and try to bake in our valuation. Now, if I look at it, if you look at this chart, this is actually consistently showing that we are taking down the valuation premium of the portfolio in last 6-7 months. Okay, we are cognizant of the fact that some of the large caps are extremely valued, like highly valued, where the margin of safety is probably lower than what can comfortable with or what we are comfortable with. So I've been consistently taking down the relative value. So it was around 1.38, probably 6 months back. Now it is kind of 1.3. Now, as a result, we are definitely kind of seeing some impact that the market is loving the large cap so much. We have kind of, I'd say, little bit of relative underperformance in maybe plus 5-6 months, but that gives us comfort on the valuation when I'm looking at the portfolio level. That is number one. Number two, for every company, we try to assign, a kind of relative valuation range relative to the market. So, for example, here we're talking about a company that you own in our portfolio. So for that company, we have assigned a valuation range that if market is trading at X time, what is the reasonable, given that is the high quality, higher growth company, then what is the reasonable valuation range that, from 1.5 to 2x or 3x of the market? That's where we are comfortable. When it goes beyond that, we take out our position. Okay, so that we do it for every company, and I can give you some examples. And as I said, the market has been giving atrociously high valuation for a few companies which we like, but the valuation we are not comfortable with. For example, Costco was one of the largest holding that we had. When we started the portfolio, we sold it around June. Okay, around 820, or I don't remember exact price, somewhere around that price. Now the reason we sold it, because from our understanding, Costco is a great franchisee. People who know this, like it's a multi-bagger, multi-year compounder, and it still can grow at around 11-12% CAGR for many many years to come. Very low disruption risk, but at the same time, we had a cap that the normalized EV to free cash flow of the company should not go beyond around 1.5 or 1.6 time of the market, and it went beyond that in June, July. So we took a decision that yes, we made a lot of money, practically almost 60-70%, 80%. Great company, but we'll probably step back, right? So again, after that, the stock has actually run up quite a bit from 820. I think it's more than 1,000. But that is the discipline that we have tried to follow. Uh, it will probably, hopefully, it works in the longer term, but the longer time frame. But yeah, that is something that we try to follow very religiously, within the portfolio.
And this, what has been sort of the outcome of this in terms of both these approaches of looking at overall portfolio uh, valuation relative to the index, keeping strong guardrails in place for individual stocks?
Yeah,
What?
so absolutely, you're right. I mean, like Kumar, what you try to do is like we found opportunities in mid cap, or not in the mega cap. So Costco is actually a mega cap. It is kind of a $500 billion company. So what we have been trying to do is that we are trying to make sure that even though we acknowledge that this is a momentum-driven thing, can work for some time, till it doesn't. But we have tried to make sure that we are more on the little bit smaller side of the index. So if you look at the allocation that we have in terms of market cap, the 50 to 250 billion dollar, in US context, you will not say the mega cap. So mega cap is basically beyond 250 billion dollars. So the market is almost, largely allocated to that. We have taken a stance that we'll be going for more on the lower side of market cap where we find a lot of value, and that's what is actually practically showing up. In fact, if you look at our sector allocation, uh, our sector is actually very much you know tilted towards industrials. Now there's a caveat here that when I say industrial, it is not the like the pure cap goods kind of industrial. So industrial has a lot of shades, but again, they are not typically the darling or often talked about names in the market. So we see the the risk reward, or what you call margin of safety, etc., is much more relevant in this particular sector or that segment of the market that we're looking at.
Thanks, Arindam. Over to you for any update you might want to give on the portfolio.
Yeah, so no, thanks, Javid. Those are great questions actually. So one of the things, I mean, we have been trying to think like how do we position our portfolio, what kind of action should we take. So one change that we have made is that we have been following this the ISM PMI manufacturing index. It's an index which basically tracks the industrial activity in the US, and it has a very strong correlation in terms of gauging earnings surprise of not select few companies but broadly. If you have a bucket of 500 companies, the chance of earning surprises in the broad-based market, not select few stocks, right? So that goes up typically when the index tends to turn around, right? So it is a predicted as a leading kind of component to it. So the way we read it is that whenever it is turning from its bottom, or if one is turning above 50, that is when you try to be more positive on the industrial economy. And for almost 27, 28 months, it was actually below that 50 range. So post-Trump election and also the low base effect, etc., that kind of kicked in. So we are taking a conscious, we made some changes in the portfolio to buy a few more industrial companies in the portfolio. So again, this is another thing where you track the new orders. You can see that that new order component. So they're getting more and more, in general, the companies in industrial, they're getting more and more orders. So we are trying to tilt it back towards more, industrial heavy companies. So as a result, we added a company called, with few other names, WW Granger. So Granger is a kind of, close to, I have to, Mayank is with us, so you have to ask him how old it is. But it has been a very old company, like almost 90, 100 years of history. Uh, Historically compounds at around, mid-teens through any time frame you can look at, actually, like, going back to that 50, 60, 70 years. Uh, we felt that it's a good time in the cycle to get into something like that. So why don't you run through the company, Mayank? You covered this company, so why don't you give some background, some history about the company, and then what it does? Uh,
Yeah, yeah, sure. So, Granger is essentially a US focused MRO distributor. So, by MRO, MRO essentially stands for maintenance, repair, and operation. So, these are essentially the products which factories or industries essentially they require for keep on running their operations. So, you can think of these products as something like fasteners, like nuts, bolts, tools like wrenches, screwdrivers, various kind of bearing and transmission products like belts, pulleys, and all. So it's a whole host of products that Granger supplies to manufacturing companies. Now, Granger, it's the largest player that operates in the US MRO space. They have close to 7% market share, and they operate in a market which is highly fragmented with a large number of small and local and regional players. Now, because Granger has been able to consistently provide its customers with the wide product assortment as well as ensure a competitive pricing. They have been consistently gaining market share over a very long period of time, and that has been a key driver for their growth. Now, a key event that has happened for this company is that in 2017, there was a management transition. And after that management transition, the company changed its approach. It focused more on volume growth and made its pricing more competitive. And that has resulted in the faster market share gains of the company. So if you look at the chart on the right hand side, if you for the period 2011 till 2017, they were gaining close to 180 basis points of market share per year. But from 2018 till 2023, that has jumped to close to 450 basis points. So that has been a great turnaround for the company, and the company has performed really well. Now, those are the more transitional effects. But if you look at the companies from a long-term investment perspective, the reason we like this company is that it has a deep competitive set of advantages. So it has one of the widest distribution network in the US. They have historically invested in automating their distribution centers. Close to 70% of their products are directly shipped from the distribution centers directly to customers. And they complement these distribution centers by having over 300 branches and on-site facilities. So that's one aspect of having very strong distribution network. The second key aspect which differentiates Granger is that they have been one of the early investors into e-commerce and have consistently upgraded their capabilities in this space. Now they have two very strong platforms, Zoro, which is primarily US focused, and Monotaro, which is a Japan focused business. Both these e-commerce platform are double-digit growing businesses. They target to small set of buyers who are essentially looking for simple set of products and ease of purchasing. So that is a key differentiator that Granger has over other competitors in this space. And finally, I would say one of the biggest differentiators that Granger has is that it has a very wide product assortment. And what that allows is to be a single point of purchase for a large set of customers. So they don't have to basically enroll five different set of suppliers to purchase products. They can just go to Granger, who can fulfill all their product requirements. So those are some of the key competitive advantages that the company has. And this strong market position has enabled the company to consistently deliver good financial performance. So if you look at their 5, 10, or 15 years EPS growth rate, it has been close to 12 to 16% and more in the last 5 years, given the change in the business strategy of the company. So that's about the past. Now, if you look at the company, what kind of growth we are expecting. So for this company, we at this point of time expect, given that we are seeing a upward movement in the US PMI index. Over next 3 to 5 years, we expect the company to deliver low double digit to low teens kind of growth, and that would primarily be driven by company delivering 6 to 7% organic growth rate, a bit of operational leverage coming up from volume growth rate, as well as cash returns. Now, given being a distributor company, Granger has a very good cash generation track record. So just to give you an reference, these guys convert close to 100% of their uh, net income into cash, and they distribute close to 80% of that cash to the shareholders, and remaining 20% goes towards their capex investment into distribution centers and technology investment. So that gives a real close to 3.5% kind of kicker to the overall returns for the customer. So as we look over the next 3 to 5 years, we expect the company to deliver somewhere between low double digits to low teens kind of growth. And that's the assumption that with that assumption, we are basically looking into this company.
Thanks, Mac. I mean, I just looked it up. Actually, it started in 1927, so
Yeah,
almost closing in 100 years.
yeah.
Yeah, it's closing in 100 years. And if I can recall, I mean, when I looked at the company like long time back, so it had a history of around compounding around 14%, 13 and a half, if I'm not wrong. Their earnings for last 60, 65, 70 years. I mean, that's a remarkable consistency if you think about it. And like as you said, 7% market share, largest player in distribution space. I mean, Very, very remarkable. In fact, one of the things that I felt, you should probably highlight here, that 2014 to 2024, practically there was, 2014 to 2016, there was a, uh, 13, 14, 15, kind of industrial recession in the US, right? And again, then COVID, then Trump tariff and all these things. So that 14 to 24 has been actually remarkably challenging in general for industrial economy. So that even delivering, 12% growth, and I'm assuming they give some dividend also, right?
Yeah.
Right.
Yeah.
So yeah, so with that, I mean, that's quite remarkable. Hopefully, if we really can get into that Trump talking about, shoring up, near shoring or inshoring of some of the industrial activity. So there's kind of optionality might come in terms of our assumption. But yeah, hopefully we're not baking on it. But thanks for that, man. So yeah, in the interest of time, what I'll do is again, you guys get this data again. So we started the year. The Jan was kind of eventful in terms of many headlines that you have definitely seen through. But broadly, as I said, we are not that exposed to the tech kind of thing, so that actually helped us to some extent. But having said that, last 5 6 months we have seen, just before 1 or 2 months, I mean, it's a massive kind of rush in buying some of the high growth tech companies. We have chosen to avoid most of them because of either valuation, or some of them are probably not profitable, etc. In real means. But yeah, so broadly, this thankfully this year started okay, so good to see that. But yeah, so broadly, since we have launched 25 27 months, yeah, the journey has been so far so good. So yeah, so with that, I'll stop here, and we'll open it up for questions.
Great. Thanks, Arindam. Thanks, Jaybir. So folks, please feel free to add your questions in the Q&A box at the bottom. We'll take as many as we can. So let's start with the elephant in the room, Arindam. The trade war, tariffs, and everything else that Trump has been up to. What would be the implications of this, particularly on the portfolio that you've built?
Yeah, no, that's a great question, but it is very hard to give a definitive answer because there are so many unknowns here. But at the same time, as I said, like we have tried to, if you look at the portfolio allocation, uh, hopefully, the tariff is generally placed to make sure that the US, whatever US is producing, that are competitive, right? So that practically means that you are building more manufacturing units, etc. And of course, it is not going to be like they're building, textile units or anything like that. Probably a little more sophisticated kind of manufacturing that they might start doing it. So in that case, as you have said that, we're increasing our industrial allocation or allocation to the industrial sector, that might actually come handy. And that's how we have been trying to position ourselves, that the companies which can actually benefit from inflation. So for example, the company that Mayank spoke about, Granger, is a classic industrial distributor. So basically you can pass through whatever the inflation is coming through. So they're kind of a very good inflation beneficiary. So if that comes through, then it will be actually good for companies like that. And again, in general, if the industrial activity picks up, as I said, like 27 months, the PMI was actually below 50. So if Trump does what he's promising to do, that is basically stimulating, the smaller businesses or stimulating industrial activities, then the portfolio is actually very well positioned on a relative basis compared to the market, with more higher weights on the industrial sector, or even higher weights on the themes which can actually benefit from what he's saying.
One more thing which we are keeping an eye on is what's happening on government spend in the US.
Yeah.
Companies which are exposed to that, it all has to be quite granular. So we're keeping an eye on developments. If any risks emerge for stocks in our portfolio, we'll obviously react to that. But that's again something we're watching.
Yeah, I mean, given I think we discussed what percentage of last year's job creation happened from the federal government, and looks like Musk is now resorting to a software to fire people. Um, you could have, joblessness rise. So, which parts of the portfolio are exposed? Presumably, the consumption part of the portfolio, or how is it sort of immune to this risk?
Yeah, so look, I mean, we are in what do you say, like, the premium kind of consumption, right? So there, I would say we are not kind of exposed to that kind of risk. So for example, our maize is one of our larger weights in consumption, or IDEX, which kind of plays into the consumption theme. But there again, on the high end side of spending, so I don't think there is too much of impact from that side, to be very fair. Um, Other than that, I mean, we do have some investments in in companies which actually provide software to the government. So, for example, Constellation Software, they have a pretty sizable unit which does software for government entities. Same way we have invested in Tyler Technologies. So, they also are provider of software to the counties, the state. So those things actually kind of benefit because your effort to automatize thing that will increase, and in turn they can actually benefit them. In fact, great that you asked this question. So we have also another company in portfolio called Heiko. So they provide spare parts to aerospace and defense. So if they actually start to become cost conscious, the DoD, the Department of Defense, or then it is actually very good for them because they provide generic spare parts to defense contractors. So that is a great way to save cost for all these defense contractors. I mean, in fact, Heiko actually spoke about that, how Doge can be a great thing for Heiko going forward.
Right. So one of the things, going back to the tariff aspect, the real tariff war started in 2018 when the big tariff hikes happened. In fact, what we've seen so far is nothing compared to that. And it's been almost 6, 7 years since that happened. There's been no change in US's manufacturing market share globally. China's share of exports to the US might have gone down, but it's found its way through other uh, sources, such as Chinese companies based in Vietnam or Mexico. Um, to that extent, it could be a similar case again that it doesn't really improve the industrial prospects of America, but just that the tariffs add cost to inflation, potentially hurting American growth eventually. I know you talked about how inflation protected is. You could have an inflation beneficiary in your portfolio, but what about growth slowing down?
Yeah, I mean that can be the case. I mean, we cannot really struck it out. So that is definitely a risk that the portfolio has. But at the same time, uh, we are not looking for companies which are reliant on that kind of additional growth. In fact, one of the reasons that we bought Granger is not because we're not looking at is a kind of through cycle massive compounder, right? So we view it as a cyclical company. I mean, that is part of our framework, that it is a cyclical company. So you don't want to suppose it gets good growth in next 1 2 years. It's fine. I mean, it's a high quality company, but it should have a cyclical tailwind. We recognize that in our when you are deciding which company to buy. So first of all, to answer your question, we are trying to build the portfolio. We have tried to build the portfolio on mega trends, which are probably not susceptible to the kind of growth slowing down, etc. For that matter. For example, I'll give an example of armies, right? So armies, you know, uh, they have around 35-40% of their business coming from China. Everything in China slowed down, but army sales didn't slow down, right? So we have tried to build positions in companies where we have that kind of conviction that they are not that dependent on macro growth. Of course, I mean there will be some ramifications, but if that happens, and maybe the companies that we have, most likely the impact on them will be much lower compared to the broader companies of the broader universe. So that's how we have tried to bake in. We definitely, play some amount of cyclicality through our different positioning, but that's part of it. I mean, but most of our portfolio is kind of more tied to secular kind of growth, which is not dependent on this slow micro acceleration or deceleration.
Right. On that piece, Arindam, you've talked about your torque framework in the past, how you tilt the portfolio based on which part of the cycle we are in. Where does your signal stand now, and how does your positioning reflect that signal?
Right. So Pramod, so when we started, it was more favoring low volatility and companies that can actually provide you earning certainty. That's when we launched it. Then towards I think middle of 2023, it turned to favor more growthy companies. So we made some changes, but we didn't went go gung ho on changing everything to growth because the we don't want to do too much of churn in the portfolio. So it has implication for investors, right? Uh, so I would say the way we use the model is to avoid massive relative drawdowns. So that typically happens when you are going from a big regime change from, say, for example, going from super defensive to super cyclical. That is when the biggest underperformance might happen for a portfolio. So we try to avoid that. Having said that, we use it quite extensively. And right now, if you ask me, we are seeing the first sign of some crack in the momentum as a signal, right? So we have started to see that. We'll see how it plays out. But we are definitely seeing after 3 4 years of very, not 3 years, almost 2.5 years of very strong momentum, we are finally seeing that it is kind of breaking down a little bit.
Right. One thing about valuations, I think you've addressed valuation concerns from a perspective of your portfolio versus the S&P 500. But if you just step back, our clients have the option of investing outside of the S&P 500 itself. And you can see where I'm getting to. China clearly has been significantly cheaper than any other market out there, of course, for a reason, but those reasons seem to be getting addressed over the past year as reflected in the spectacular performance of the Chinese market, the concerns over the Chinese government's sort of hammer hold on the tech sector also seems to be addressed with the conclave that Xi Jinping held with the tech leaders. And from whatever we've seen as demonstrated by DeepSeek, it's not like Chinese technology is any behind either. How would you compare the prospects of the Chinese market returns versus GCP?
Yeah, look, I mean, my stance on investing in China, it is probably unchanged. We have always maintained that, before even this rally happened in, I think, September timeframe, right? So before that, that is a trading market. That doesn't change. So if, when it is super cheap, you can buy it. But as I said, when you are looking at this thing, where is it? Yeah, this earnings growth number. And as I said, like, if you take out just last 3 years, what happened in China, take that out. If you look at last 15 years of earnings growth, say 2005 to 21 or 2006 to 21, that is still at around 7 8%. Okay, not bad, but it is not something spectacular, or the predictability of that is much lower that I would like to put a very high multiple on that. And from that standpoint, as I'm telling you, like, it's trading at 13 times. You probably pay 20% extra, which might give you, the S&P mid cap for that matter, right? So you get probably a higher growth with higher predictability, and higher ability to analyze companies in a country which, where you can predict something. So when you are, trying to invest somewhere, you have to have some kind of predictability. uh, unless we have that, it is very hard for us to make a case to make a case for investment. So my view, I mean, Javier, please jump in here. Given the deep seek thing, we have never doubted China's ability to do great things in what they do. I mean, as you said, manufacturing is their, I mean, they're great at it, no doubt about it. There are many other things that they're actually great in it. But when it comes to shareholder value creation, the basic framework revolves around the fact that you have to give good return on equity. That's when you can get good valuation. And from that standpoint, we're still much more comfortable being in the markets where we have seen that kind of discipline.
Right.
So on the tech side, look, China's capabilities, even before DeepSeek and even outside of AI, have have been proven time and again. The primary example I would point you to is TikTok. Like TikTok created the short form video market globally. Right? In India, it's been banned for a few years, but in the US, it's a major consumer app. It's taken away a lot of attention share from people like YouTube or Instagram in its heyday. Now, that app was created by Chinese engineers. The original concept was for an app which is still live in China. It has a different content profile, but it's the same basic concept of creating a very addictive short form video app. If you look at BYD, the electric cars they make, one can argue they're probably better than anything made in Europe. And Europe's been making cars for a lot longer than China has. So the capability is never in question. What has become a question mark for Chinese tech companies in particular in the last 5-6 years has been market access. TikTok squeezed through before that, right? It started in 2017. If it had started in 2019-20, it would never have been allowed to even launch in the US. That's what's happening to Chinese cars. There's simply no way to sell them in the US. The issue isn't the quality of talent or the engineering jobs. The issue is market access for a lot of these Chinese tech companies is restricted. Look at it this way. If a company came and told you they were using Alibaba Cloud, would that inspire confidence? So it's that's the basic issue. The issue is not capabilities; it's the market access.
Right. Flipping this point on its head, in a trade war, tariff war, geopolitical situation, would the reverse also hold true? Would some of your tech companies be restricted in terms of market access to China, for example, as it's been in the
They
news for the last
already
couple
are.
of days?
So the only amongst the big tech companies, the only one with a major China business is Apple.
Microsoft?
Google, not that big. See, half of Microsoft is still US. China is not amongst their bigger markets. Remember, they're an enterprise tech company. So to the extent that enterprises have business in China, they'll be using Microsoft there. But if it's a Chinese company, it's less likely that they'll be using the full suite of Microsoft software, especially their cloud software. So that risk has been playing out for the last decade and a half. I think Google left China somewhere in the late 2000s. Facebook never launched there. Instagram never launched there. There are restrictions on the sale of a lot of semiconductor equipment to China placed by the US. There's restriction on the sale of chips to China placed by the US. So for US companies, it's that lack of a market in China has been a reality for a while.
Fair enough. So look, I mean, there's a question as to, is the fund allowed to buy a Chinese ETF? You reckon, it's hard to access the market, but, I'll answer that on your behalf. I mean, whether it's allowed or not, it's not going to be a value add from our perspective. The value add from Jabir and Arindam and team is to be able to evaluate businesses bottom up and buy those businesses for you um, in the portfolio, as opposed to doing asset allocation from a geographical perspective. And it's easy for most to access Chinese ETFs, for example. You don't need to pay us any fees to do that. So I'll leave it at that. One of the concerns, sort of related to valuations, is around the state of the bond markets. Right, so with bond yields going up to 4.6%, from a relative valuation perspective, aren't US bonds a lot more attractively valued today compared to US equities? And what does that mean in terms of future returns? Is there any past data to see that when US bonds have yielded so much, what are future returns from equities?
Well, I mean, yeah, Jabir can go ahead, but broadly, what I have seen is that in the 4.6 or 4.5%, it is the more of a 2000 mid 2000 phenomenon. That's when the bond yields are actually at that level, 2004-5. Um, from there to now, uh, I mean, from there to now is not actually not the right thing, because from there to say 2021, when the bond yield actually went to zero, then the bond actually did pretty well. But after that, it has dropped precipitously in last 2 years, 2.5 years. So uh, depending on the view, like, will you go to again zero kind of rate situation? Probably unlike something like a COVID happening where you need to print money, left, right, and center. You're probably not going to go there. If not, that is not the case. We do not have that much of historical proof, that to say that the equity markets lag bond market from that standpoint. That is where again the Pramod made a point at the beginning, the asset allocation perspective that comes into play. You don't want to be in like super high risk kind of equities who are just solely dependent on what the bond prices are going to be. Javier, you
I
want to
guess
add something?
the specific question, the gentleman who's asked the question seems to be referring to is the gap between bond yields and earnings yield, rather than the
Oh,
absolute level of bond yield.
oh, okay. Okay, got it. Yeah, so again, so if you're looking at the market level, so in that sense, I mean, you'll find a lot of charts that floats around in Twitter, the earnings yield gap, and the forward market return. And that's what I'm saying, that you should be careful about just going about in the index. So you should be very careful about the valuation. That's why you need to probably look into the just below the hood a little bit, because you are right. Historically, if I go by history, purely data from that standpoint, the forward returns are not that great when the earnings yield and the gap between the bond yield basically that's so low at this point of time. And we have not actually do not have too many of those instances, if I can recall.
Correct. Fair enough. And there's a question on, can we publish some portfolio analytics? I think they've asked, what's the dividend yield of the portfolio? What's the debt to equity position? And then I can add from my side, the free cash flow growth or earnings growth of the portfolio over the last 5-10 years. Is that something that we can share with our clients?
We can share, but I mean there are some risks. So I can tell you like 80 to 100 basis point, basically 8.8% to 1% is the dividend yield of the portfolio. Earnings growth since we have launched it 2.5 years. One way to look at it is like how your forward earnings have grown. So that has been around 17-18%. Historically, these companies have grown at around high teens on a portfolio level. The reason we cannot share the historical data for these companies, that is more compliance related, because we didn't have the portfolio 5 years back, right? So portfolio is just 2.5 year old. So that's where it becomes a little bit challenging. But broadly, it has been in high teens or low 20s actually somewhere between that. But since we have launched, it has been around 17-18%. Free cash flow, all our companies convert, like if I take an average, probably 100% of the net income is converted to free cash. So the growth is very similar to what you see in the EPS growth. Then the debt to equity, other than one or two companies, actually one company, these companies are mostly, within net debt to EBITDA of below 1.5 to 2, 2x, right? So the leverage is never a concern. There's one company that operates like a private equity company that we have in the portfolio. So their business model is kind of, dependent on keeping a high leverage. But broadly, it is not susceptible to, more or less not less susceptible to what in terms of blowing out because of high debt.
And would it be fair to say that the IRRs one should expect from this portfolio, if you were to hold on for 5 years, would be in line with the free cash flow growth of the portfolio? What do you have in mind?
I would assume so. Look, I mean, depending on the end point, right? So you don't know the end point what the valuation etc. would be. But broadly, where the portfolio is, we expect around mid-teens, around 14-15% of free cash flow growth on the portfolio. Historically, as I said, they have done much better. But going forward, I think 14-15% is a good free cash flow compounding for this portfolio. It Valuation wise, we cannot say much. I mean, it can go up, given that go up in the sense that many of these companies will be transitioning from a mid cap to large cap, so that might push the valuations up. We have seen that for many companies happening. But at the same time, as we are talking about the market valuation might come down. So there are a lot of other factors, we cannot really predict them. But if you are holding it for a long period of time, I would say there's a very high probability that you get a fundamental compounding kind of final return.
Got it. And one last question, perhaps the biggest question everybody has is on the sustenance of US debt. I don't know, stop counting after $30 trillion, it must be significantly high. What are the risks posed to it? And related to that is the fact that Japan and China, the two biggest holders of US Treasury, have started reducing the Treasury holdings. In fact, perhaps reflecting also in the rally in gold prices. How do you connect US debt to this de-dollarization and potential returns from the US market?
Oh, that's quite a few things actually baked in there. So, okay. So US debt, yeah, I mean, it is, I think, 35 trillion or 36 trillion now. Added $4-5 trillion more. But if you look at it, I mean, broadly, the debt is 120%. I mean, the government debt, which is not low. Japan, if you look at that, is almost 250. And the other European countries are around 100. In fact, if you take out Germany from the European Union, most of the countries are actually above 100 or close to 100. China, India, 84. So again, look, I mean, high debt is not comfortable for sure, but you have to look at from the perspective of, on the relative positioning. Like if you had other major countries sitting at a debt level of say 30% debt to GDP or something like that, and then there could be a very good argument that there is someone who is as powerful as you are, have a very good financial health from that standpoint, right? But what you see in the world, that is not the case. So even though the absolute level debt looks very high, and the ratio is also high, there's no denying of it, but it is a $30 trillion GDP country as well, right? So the numbers that comes out, they look like, very disturbing. But that's what it is. And I do not have a view on that, at what point of time it becomes a problem. It will ever be a problem or not. As I said, there are not too many alternative forces that you can see as of now. And that change of leadership on dollarization or, this kind of big things, and that doesn't happen overnight. It needs a big economic event to trigger this kind of changes. So, So I'd say that, it's kind of a Goldilocks status quo kind of situation. So just live with what you know and what you can predict, which is basically, predicting the company's earnings capability, etc. And then coming out of, gold, I have, I mean, people have spoken to me. They know that, kind of, I always say that, gold should be a part of the portfolio, especially when you live in a situation like the fiat currency era, right? So you need something like that to be part of the portfolio. Again, that comes to the asset allocation decision, right? In terms of return, how that impacts the return of the portfolio or broadly US, uh, very hard to say actually. We don't have a clear answer to that. I can make up an answer, but that will not do justice to, it's a much more deeper question, I think. Javid, you want to add anything?
Fair enough. Fair enough. Great. No, thank you. Thanks, Jabir, Arindam, and Mayank. This has been extremely insightful. Folks, thanks for dialing in. If you have any questions, feel free to write into us at invest@marcellus.in. We'll be happy to get back to you with answers. If there are any unanswered questions from the Q&A queue, we'll reach out to you individually and help answer that. Thanks once again.
Thank you.
Thank you.